It has been a turbulent week for global markets as the culmination of several macro events and published economic data points caused equity markets to fall sharply, volatility to rise in a number of currency pairs, and gilt and treasury yields to fall. Far weaker than expected data on both employment and economic activity within the manufacturing sector in the US caused concerns around whether the Federal Reserve had waited too long to adjust monetary policy, and a potentially higher probability of recessionary risks. This coincided with further geopolitical tensions in the Middle East and an interest rate increase by the Bank of Japan, causing a number of global investors to unwind carry trades whereby funds had been borrowed in Japan, given the expectations of continued structurally lower interest rates in the country to fund investments elsewhere. Whilst this is an extremely short period of time to analyse against, and we expect volatility and market expectations to ebb and flow over the coming period as more data and policy announcements are made, this was still an opportune time to speak to Dan Roberts, the long-tenured manager of Fidelity's global dividend strategy. Welcome to the Investor Insights podcast, hosted by Killik Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on topical issues. You can access the full series of interviews via the playlist on the Killik Co YouTube channel, or by searching for Killik Co's Investor Insights on Spotify, where you can subscribe and be notified of future episodes. We hope you're enjoying the discussion so far, and you can get in contact with us about any of the topics discussed via the email address investorinsights@killik.com. Killik Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan and invest. And you can find more details on the unique ways in which we do that at our website killik.com. In today's episode, we were joined by Dan Roberts, who joined Fidelity in 2011, but began his investment career back in 2001 as an equity analyst for M&G, before running funds at Invesco, Aviva and Gartmore. Dan is a qualified accountant by background, and his strategy at Fidelity is characterised by a strict and well-considered investment process. The emphasis here is on investing in businesses where there is a strong confidence in the sustainability of the dividend, and where the current market valuation provides an adequate margin of safety. In our view, the successful implementation of this process is evidenced by the return profile of the strategy. The fund has an unbroken record of increasing its own dividend each year since launch, including in that tricky period during the pandemic, which disrupted the operations and dividend-paying capabilities of a multitude of companies. The strategy has also proved far more resilient in periods of broader market weakness, as the value bias, but crucially this not coinciding with high levels of debt or cyclicality, has provided a level of protection during those inevitable risk-off periods over time. Whilst only few areas of the market were completely immune from the market volatility over the last several days, the brunt of the market sell-off has been felt by those areas which have performed particularly strongly in the prior period, notably in the higher growth, higher valuation multiple areas, such as in the large cap technology sector. We've discussed the topic of the narrow breadth of recent market returns in many of the prior episodes of the Investor Insights series so far. The aggregate returns of global indices do often hide within it notable swings in the market leadership, with certain sectors or companies with specific characteristics often notably outperforming at the expense of others for sometimes prolonged periods. We've undergone several notable changes in market leadership over the last decade. On many occasions, more sustained market leadership swings have been triggered by events such as the changes in political rule within major economies, a reversal in the stance by central banks, and evolving forecasts on the economic outlook. Given this, you can understand why many market commentators are discussing the potential for a regime change within markets at the current time. However, these catalysts, along with the market reaction to them, tend to be extremely hard to predict, particularly with any consistency, but they can have a significant impact on the performance of the active element of portfolios. It is for this reason that we believe investors will be well served by looking at the diversification of the active element of their portfolios, not just by traditional methods such as geographic exposure, but also through the lens of investment style factors or by underlying growth drivers. From a fund selection perspective, when looking at active strategies, we typically favour managers and teams with distinct and consistent investment styles, underpinned by a well-defined process, and we encourage the blending of these styles together within portfolios. Style factors in this context refer to the method of stock selection based on a specific set of characteristics. There's a huge amount of academic literature on the benefits of factor or style diversification, and also significant research showing how the successful adoption of certain styles can lead to long-term persistence in return premium over and above broader indices. However, we often think it requires a very different skill set, investment philosophy, and even personality to successfully adopt different investment styles. And I hope during this episode with Dan Roberts, his specific investment style and the priorities governing his valuation-focused approach to investment comes across in the discussion. Hi, Dan. Thank you so much for joining us today. How are you doing?
Good, thanks, Gordon. Thanks for having me.
No problems at all. Thank you for coming on. So our kind of standard first question that we ask in these discussions tries to get a bit of an insight into you, really. We've been asking people to give us a kind of idea of what a typical working week might look like, or a bit of an insight into a research project that you're doing. I wondered if there was a kind of anecdote from a recent company meeting you could share, or even just a kind of article or book. We've had some book recommendations in this bit as well. Anything you could share?
Yeah, okay. Well, in terms of a research project, I think one of the most interesting things I've done over the last few months, at least, was a site visit to the HQ of Inditex in A Coruña. I hope I pronounced that right. It's on the northwest coast of Spain. For context, I don't know if you know, but Inditex is a relatively new position in the portfolio, and I think you or your listeners will probably know it better as Zara, the fashion retailer on the high street. It's a company we've admired from afar for a very long time. It's a best-in-class operator, a business model, without getting into too much detail, it's a business model based around what they call proximity sourcing, which essentially enables them to get product lines from design to in-store in just a few weeks, compared to what can be several months for most of their competition. So that keeps their product relevant and means they avoid markdowns, which is typically the biggest expense for a clothing retailer. So, long runway of growth ahead of them, well-invested asset base, strong balance sheet. For all these reasons, it's a company, like I said, that we've admired for a long time. But I think the real insight and conviction building, to answer your question, came from a visit to their HQ. So seeing it firsthand, hearing tidbits and anecdotes which give you a real understanding of their culture and what has made them so successful. So whether it was, for example, seeing for myself just how flat the organization is, very light on central functions, very decentralized decision making, no offices, no nameplates or titles. Anecdotes like the fact that they spend almost nothing on advertising or PR because they want the product to sell itself, or even just seeing what they built during the COVID lockdowns. That was a period when many businesses were playing defense, but their response to that was to accelerate the investment projects that they had already planned. So, they'd be even better positioned coming out the other end. So, all individually small pieces of the jigsaw, but the site visit and that interaction really helped to construct a pretty comprehensive understanding of not just the mechanics of the business, but also, very importantly, the culture, which then gives, of course, confidence that their competitive advantage can be sustained longer term.
Fascinating business, doing things very differently. So thank you for that. Dan, I appreciate that a lot of what you do is kind of looking at individual stocks. I mean, that's become clear in the very first question I've asked. But I want to ask you about the kind of the overall market, if I may, and I guess we're catching you in the middle of a pretty roller coaster week this week. But if you're kind of looking back at the last kind of several years, one of the kind of characteristics has been that kind of narrowness of the breadth of the market, kind of the dominance of a relatively small group of stocks. And when we've seen some of your presentations over the years, you've often referenced the kind of long-term market regime and the downside risk you see when things kind of turn. Could I ask you to give a bit of a take on the market at the moment against that context?
Yeah, so I guess some of those presentations that you mentioned, I think one of the things I tried to challenge is this idea that the index or the benchmark represents the low risk option to investors. So, of course, I understand the attraction of passives and index funds, obviously cheaper products, and over recent years have performed better than many active strategies, in large part due to the concentration issues that you just referenced. But I think because by definition, for index strategy, the deviation from the index is minimized. I think a lot of investors see them as the zero risk or at least a low risk position. But I think it's important to understand that sometimes the index itself, can be laden with risk, heavily skewed towards stocks which are either overvalued or over-earning. And by over-earning, I mean, generating profits today, which they will ultimately find difficult to sustain in the longer term. And of course, as an active manager, talking my own book here, but you'd expect an active manager to identify and protect you against those risks as they build within the market. And I guess the obvious example would be the tech bubble, almost 25 years ago now, but tech comprised roughly a third of the index at the peak, and having a third of your assets, such an allocation to that sector, of course, proved very costly as that bubble burst. So the statistic I like to share is, and you might have heard me share before, is that in the 5 years post that peak, the S&P declined by 23%, whereas the average stock in the market was up over 30%. So, there was a lot of opportunity to make good returns in that market, but also a lot of risk in the index itself, which I think is the important point. And I guess a similar situation in 2008, 2009, when the index was heavily represented in financials, commodities, and China ahead of the GFC. And just to be clear, I'm not making direct comparisons between now and the tech bubble 25 years ago. I think there are important differences, but that concentration risk, I think, is something investors just need to keep in mind, particularly with tech and the rest of the Mag 7 representing, now over 40% of the US market. And obviously, that's had a big impact, as you mentioned, over the last couple of weeks.
So, Dan, maybe again against that kind of that backdrop of what you just described, could you maybe, is it possible to provide a bit of a summary of how the fund is currently positioned? Are there any kind of general themes to where you are finding opportunities?
Yeah, of course. I guess there's a couple of things to highlight or to mention. First, just philosophically, we are truly unconstrained in our approach to portfolio construction. So we don't start from the index and ask ourselves, should we be underweight this region or overweight that sector? Instead, we start from a blank sheet of paper and look to put together a relatively tight collection of stocks, which we think will best help us achieve our targeted outcomes. So the result is a portfolio which looks and behaves very, very differently to the index. For example, you asked how the fund is currently positioned. Well, at the moment, we have roughly a 30% allocation to the US, which we actually think is a healthy allocation from that blank sheet of paper that I mentioned. But of course, within global indices, the US represents roughly twice that percentage. So we have much less in the US than you would get if you bought an MSCI kind of world index tracker. The second thing to bear in mind is when thinking about positioning, at least, is the outcome we are targeting, and then what that means regarding the kinds of companies we are likely to own. So in short, we look to manage two types of risk, valuation risk and fundamental risk. So you won't see companies in the portfolio which are richly valued or, of course, pay no dividend. And you won't see businesses either where the fundamentals are perhaps overly complex, very volatile, or where the range of outcomes is potentially very wide and very uncertain. So in practice, then, that means at the moment, again, regarding current positioning, we don't own any of the Magnificent Seven. Perhaps understandable for a dividend strategy, but maybe more surprising is that we're absent some of the more traditional income sectors. For example, telecoms, REITs, banks, and commodities. We own nothing in any of those sectors. And then I think you asked, in terms of where we're finding opportunities at the moment. So there's no themes to speak of, really. What I would say is that after the strong performance of cyclicals and relatively disappointing returns from from many defensive sectors. I think it's fair to say we're finding more ideas in the latter, though as we speak, things are changing pretty rapidly. And then more generally, as you know, we tend to look at what we think are good businesses, which maybe we haven't owned in the past on valuation concerns, but for one reason or another, may have derated, thereby kind of bringing them onto our radar. And there are quite a few examples of such companies at the moment. I could throw a few names at you, the likes of Hershey, perhaps Kone, LVMH, Starbucks even. So these are stocks which have come back a long way. None of those are recommendations, by the way. I'm just trying to give you an indication of the kinds of opportunities we choose to spend our time on. And in practice, I'd say probably for every 10 such ideas that we do detailed work on, only one or maybe two find their way into the portfolio.
I was going to ask you, Dan, about that kind of balance between cyclical and defensive sectors. Because I've often seen you kind of split the portfolio up in some of your slides to that regard. Can you maybe talk us through kind of again how the kind of current portfolios looking within that balance, and maybe talk us through an example within each of those segments so we get an idea of kind of what you're looking at there.
Yeah. So just to be clear, that's not something we manage top down. It's purely a result of our stock selection, but we show that split in presentations just to give some kind of high level insight into the portfolio positioning. The other thing I say is that portfolio turnover is low. It's about 15 to 20%, which means, of course, that the average holding period for a stock is over 5 years. So that split doesn't move around a lot. Having said all that, we currently have about 2/3 of the portfolio in companies where we'd classify the end markets as defensive and about 1/3 in cyclicals. Now that ratio has been fairly consistent. We are, at the end of the day, looking for resilience in company fundamentals. So we'll always be skewed towards companies with end markets less exposed to the kind of economic kind of ebb and flow. But we do give ourselves the opportunity to invest in more GDP sensitive stocks if we think they're high quality. And by high quality, I mean they offer good cross-cycle growth, allocate capital well, and particularly for cyclical stocks, maintain very strong balance sheets. The 2/3, 1/3 split, like I said, doesn't move around much. It's probably a little higher than usual on the cyclical piece, which reflects the stronger performance of some of those holdings. And then maybe an important point to highlight in terms of how we achieve the defensiveness of the overall strategy. As I said already, we achieve that through stock selection rather than any heavy top-down allocation to traditional defensive sectors like staples and healthcare. In fact, our exposure to some of those traditional defensive industry groups can be quite low, and overall the fund has a pretty good balance. It isn't skewed heavily to any one industry group. And then in terms of examples in each, so maybe Legrand would be a good example of one of the more cyclical holdings. I don't know if you've heard of that company, but it's a specialist in low voltage electrical equipment for building infrastructures. It has good market shares in the geographies in which it operates. So roughly 2/3 of their revenues are from regions in which they have market leading positions. So that gives them great pricing power. Also, roughly half of their revenues from renovation, which gives them some of that resilience that I mentioned that we look for. They stand to benefit longer term from electrification, which is a very powerful theme, of course. But short term, they've been faced with some difficult end markets, particularly in residential and office. So I don't think we're anywhere near a cyclical peak for the company. Great management team, resilient margins, despite the cyclicality of the top line. So putting any call on the macro to one side, I think it's just a great stock to own for the long term, and it's a top 10 position in the portfolio. And then on the defensive side, a stock you certainly would have heard of, Tesco, maybe one worth talking about. I think you probably know what they do. Not an easy marketplace, but the stock is priced accordingly. Very high free cash flow yield. So we're talking about high single-digit free cash flow yield, which tells you ultimately that the expectations for future growth are fairly low for this business. So that's a low bar for them to beat. And at the margin, the competitive dynamic is improving, whether it's due to over-indebted peers in the hands of private equity, or just the significant narrowing of the price gap versus some of those discounters like the Aldis and the Lidls of the world. So it's looking good. I should also say it's a very different business to 10 years ago. They focused back in on their core after a period of trying to operate in in too many places and across too many verticals. So a more defensive holding, but still with some good stock-specific drivers.
Yeah, some good examples there. Yeah, thank you for both of those. Dan, I wondered if I could maybe touch on kind of how the portfolio, you referred to the fact that turnover is low, but kind of are there any kind of themes to how the kind of portfolio has been repositioned over the last couple of years? I mean, obviously we've had that big change in interest rate environments, and I guess it's put kind of a lot of scrutiny on whether it's debt levels or capital allocation. I wonder if there are any themes on kind of what you have done within the portfolio, given that kind of big change in the backdrop.
Yeah, so you might not like my answer here, but I was going to say, we're not top-down investors. So one thing we certainly don't do is rely on historic correlations between a macro variable and share prices to inform our decisions. You often hear strategists saying, interest rates are heading up or down, therefore you need to buy this collection of stocks. I think, there are two problems with that. First of all, you need to get your interest rate call correct. And then, of course, you need to hope that those historic correlations hold. But I think the real issue I have with that kind of approach is that it ignores valuations and what is already reflected in the stock price. And for us, that instead is the starting point. We spend a lot of time thinking about what is already reflected in the share price and the consequent risk reward, vis-a-vis a range of macro outcomes. In terms of, you asked about capital allocation decisions being made in boardrooms and how interest rates may affect those decisions. I wouldn't say there's been any discernible change yet in the behavior of company execs at these higher interest rates. We have seen some write-downs of goodwill and intangibles as discount rates have risen. So perhaps that illustrates that some of those deals done over the last decade were not the best and relied on a relatively low cost of financing. So hopefully that gives management food for thought on the M&A front. As I think we're very skeptical that the M&A, particularly large-scale M&A, adds any value, and that often prompts us to exit a stock if we see some of our companies engaging in that kind of activity. And perhaps an interesting one is buybacks, particularly in the US, of course, where they've been a pretty useful tailwind to earnings per share as companies have effectively been arbitraging the cost of debt and equity, so raising leverage to buy back their own shares. That clearly works when borrowing costs and equity valuations were both low, but of course both have now risen quite significantly, and that arbitrage has essentially disappeared. So raising debt at 5% to buy back your shares trading on 30 times earnings, the maths just doesn't work. So perhaps we'll see fewer buybacks going forward, and who knows, maybe even the dividend will make a comeback. So those are some of the, I guess, themes I would pull out. But like I said, we're not top-down investors, so we're not pushing any themes into the portfolio.
Yeah, no, sure. Yeah, some good points made there. Yeah, Dan, so obviously the portfolio, as you've kind of made pretty clear in the prior question, is always going to have a kind of value bias relative to the broader market. And that, if you kind of look at the return profile of the fund, that valuation support is historically provided kind of downside protection to the portfolio. I wondered if you could talk us through kind of how else you consider ensuring diversification and resilience when you're kind of constructing the portfolio. Obviously, you've talked about sectors that you're kind of largely avoiding or entirely avoiding, but I wondered if you could maybe talk us through how you think about diversification and resilience.
Yeah. So I think there's three things that we think about. So the first two relate to how we pick individual stocks, and I think the third relates to how we put the portfolio together. So first, as you mentioned, the valuation support, making sure we don't overpay. No matter how promising the prospects for a company may seem, there'll always be a price at which we think the valuation risk is too high. So companies priced, for perfection, so to speak, they only have to hit a speed bump for the equity to fall quite considerably. Worth saying at this point that it was our valuation discipline that protected us in 2022, a year when we still managed to eke out a positive return for a UK investor at least. If you cast your mind back, you may remember it was the expensive growth stocks in the market that derated aggressively as interest rates first started to rise from their lows. And because we had relatively little exposure in that category, we didn't suffer as much as the broader benchmark. So that's the first kind of risk we look to manage. Then also at a stock level, as I touched on earlier, we look to manage the fundamental risk of our holdings, which means in practice identifying companies with resilient earnings and balance sheets. And as I mentioned, we could find them not just in the obvious places, like staples and healthcare, but across a wide range of industries. So, for example, professional publishers, you'll see well represented in the portfolio. So companies like RELX and Wolters Kluwer, those companies have a high percentage of subscription-based revenues. In capital goods, we look for companies with high aftermarket exposure. Within financials, we own some financial exchanges, which to some degree are almost anti-fragile in Taleb speak, in that they benefit from increased market volatility. Non-life insurance is another one, and it's this characteristic of the portfolio and the stocks we own within it. I think we would expect to protect us in an earnings-led downturn, so a more typical kind of recessionary scenario, if you will. So that's at the stock level, and then when we're putting the portfolio together, ultimately we think about the correlation of fundamentals with other holdings. So we have a portfolio of companies which of course share some common characteristics, but may operate in different geographies or be exposed to different cycles which are asynchronous. For example, one stock may be exposed to a housing cycle, another an R&D cycle, maybe another a regulatory cycle, and because those cycles, like I said, are asynchronous, that of course improves the overall risk-return profile of the portfolio. So that's what diversification means to us. It doesn't mean we feel it necessary to have exposure in every sector. As we've already highlighted and as you just mentioned, there are parts of the market where we can't find any suitable ideas, then we just won't go there. So diversified, yes, but each stock essentially needs to stand on its own 2 feet.
Dan, our kind of standard final question is one that asks the speaker for might be an area of the market or a particular stock within the kind of investment universe that you have a particularly high conviction in at the moment. And you kind of mentioned a few areas already, but I wondered if there was a kind of area or stock that you'd pick out just to kind of close the conversation.
Okay, yeah. It's a bit like asking to choose your style, but okay, let me pick one that maybe you haven't heard of before, a stock called Packaging Corp. In the US, they're the third largest producer of containerboard and corrugated products in North America. They sell into a broad cross-section of industries. Now, I'm immediately aware when I describe what they do to you that it sounds as though there's little value add here. But the point is that they're such good operators and capital allocators that their financial metrics, stand apart from the rest of the industry. And in many aspects, in fact, they're as good as, if not better than some of the consumer staple companies that we look at, which of course enjoy huge brand equity. So phenomenal financial metrics. It's another company like Inditex, we mentioned earlier, has a very strong culture, which helps explain that performance in a relatively commoditized industry. And the fact that they're in such an unexciting sector or industry, I think keeps a lid on the multiple, which means you can access those characteristics at a reasonable valuation. Again, I wouldn't want to make a tactical call on it right here vis-a-vis the macro, but I think if it's a stock you're willing to hold longer term, it's one you'll do very well out of.
Yeah, it sounds like one that ticks a lot of boxes for your criteria for sure.
Yeah,
Dan, as always, really, really nice to catch up with you. Thank you so much for sparing some time today.
Pleasure. Thank you very much for having me.
Thank you for listening to the Investor Insights podcast, hosted by Killik Co. You can get in contact using our podcast email address, investorinsights@killik.com. For more information on any of the topics discussed, or for further details on the services offered by Killik Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killik Co is authorised and regulated by the Financial Conduct Authority, the FCA.